A very good day, everyone. This is your European Open briefing for Thursday, July 7th. My name is Michael Florentiades. I am the Chief Economist here at XM, and here are the key points you should be looking at today. The markets are calming down a little bit after a positive Wall Street session yesterday. The yen, though, pushed the dollar down to 100.19, and it looks like the 100 level is in the market sights already for dollar yen. Sterling remained volatile but avoided making fresh lows. It even looked like it might be testing 130 in the next during the coming sessions. Australia's credit outlook was downgraded by S&P. The country might lose its AAA rating, but the Aussie was not much moved. This is because of the political uncertainty created by the hung parliament following the elections. It might be difficult to get a strong government after the elections, and a weak government will probably be less willing to put in some fiscal measures that are going to reduce their deficit. In the calendar today, we have UK industrial output to look forward to and US jobless claims. We also have the US employment report tomorrow, so that should be on most traders' minds. Now, this is a chart of the 2-year Treasury note in the United States, its yield more specifically, and it shows that what happened following the Brexit referendum. Before Brexit, we were up to we were at around 0.8, 0.78, and now we are at 0.58. So what this chart means that the market expects interest rates on average to be around 0.58 for the next 2 years. Keep in mind they are around 0.38 right now. So this shows that on average we are expecting 1 or 2 hikes over some chance of 1 or 2 hikes over the next 2 years. Now, 2018 is starting to look like the most probable year for the next rate hike, and of course this contradicts with the view that we were going to get a rate hike in December. Before that, now the rate hike in December is not looking as likely, and of course this subdued rate outlook is keeping the dollar from rising too quickly, even though it is a safe haven. We will see about that in a couple of slides. Now, this is the S&P 500 futures. It has been helped by the dovish rate outlook, and the US economy also not seen as impacted much by Brexit woes. However, we have said the Fed is not taking any chances. It's looking at the markets are volatile, and it's saying we will keep rates unchanged. Yesterday we had some positive data in terms of an impressive jump in the June services ISM index, the business confidence in the services sector. It jumped to 56.5, which is a 7-month high, from last month's 52.9. I think expectations were around 53.3. So the signs from the US economy so far show that last month's payrolls miss. The very low payrolls that we got last month, or 38,000, was a one-off. We have a look at the dollar index. We see the big jump in the dollar index right after the Brexit referendum. Overall, the dollar has been strengthening following the referendum Brexit, but not versus the yen. So maybe what we are getting is some profit taking. So this fall from 96.4, 96.5 to the current level of 96 for the dollar index is some profit taking on the rates outlook, and as a little calm returns traders are willing to risk going into more risky currencies. And tomorrow's payrolls, of course, will be key for the US dollar. Now, we had Japan's foreign reserves going up in June, not by a lot, but by around 11 billion. We had German industrial output severe miss, and this is coming on the back of yesterday's miss in factory orders. So looks like manufacturing in Germany not doing so well. We will look at the industrial output out of the UK. Now, of course, people are going to say this is very old news, given that Brexit has taken place. It's a new circumstances, a new scenario, let's say. But keep in mind that some are pointing out to the fact that the UK economy was already weakening before Brexit. Therefore, Brexit could reinforce this downturn. Of course, it will be a negative for growth. So if the UK economy was decelerating before Brexit, then we're probably going to get a recession in the UK. If the UK economy was doing okay before Brexit, maybe probably we'll avoid a recession, just see slower growth. So this is why we want to see what was going on before. We also have the ADP national employment numbers, private payrolls from ADP. Initial jobless claims expected around 270,000, and of course crude oil inventories. And I should note that oil posted impressive gains yesterday because we had the API inventories. The market also made a comeback, and it made a strong rally from 45.80. This is the WTI in the US contract. 45.80 jumped all the way to 47.90. So this shows again the relationship between market moves, stock market moves, and oil maybe, and confidence report returning, and the price of oil. And we are also going to get the ECB meeting minutes. So that's all from me today. Thank you very much for watching, and have a great day.